So you are able to now see the YouTube live as well as the TikTok live. We're going to have a few moments go past just so we have a little bit of time before members are able to actually see us go live. We just posted it on the Discord there, so now we have it notified to our Discord members. So we're going to wait for a few more moments here while we are going live. The news stories, quickly going to talk about Bernie Sanders dropping out of the presidential race and then going down the situation, obviously, with GDP slowing down and looking at just how impactful this is to the economy, looking at the GDP of 2008, how much it impacted the total GDP, and then looking at what we're expected to have happen in really 2020 here. So let's get this recorder started and then we'll get on our merry way here. How's it going, Truck Nubs? Rolling with Truck Nubs. Got a different name, I see. All right, so I'm gonna get this recording started here. Hello traders, and welcome to another global macro update. We're going to be covering some news topics today, mostly talking about how the GDP is affected and what we've seen in previous historic recessions and how that affected GDP and what the so-called analysts, I guess, are looking at the economy and what they're expecting this downturn to be hitting as a percentage in terms of the GDP going down. So we'll talk about that in the video. Quickly, just going over Bernie Sanders dropping out of the presidential race. I'm sure you've heard, but if you haven't, yeah, this is pretty big news. So we now have just Biden here and Trump mainly. So we'll see how it goes. I'm not going to go too far into it. I'm not an American citizen, so it doesn't really... I have no say whatsoever, so if you are a voter, definitely tough choice there. So let's go into the main topic of the day. State shutdowns have taken at least a quarter of the U.S. economy offline, and yeah, it's extremely substantial here. At least 1/4 of the U.S. economy has suddenly gone idle amid the coronavirus pandemic. An analyst conducted for the Wall Street Journal shows an unprecedented slowdown for commerce that economists say has never occurred on such a wide scale. I'm sure you guys and girls are well aware, but we're actually going to get into some numbers and looking at just how impactful this is, because when you say it's impactful, there's no real gauge as to how this is actually going to affect the economy in terms of how did other recessions affect GDP, looking at 2008, 2001 dot-com boom, and then the real estate crash and the financial breakdown of 2008 there. So we'll go into those timeframes and look at how GDP was affected, but let's read further into this. We see Mark Zante, chief economist at Moody's Analytics, doesn't believe that 29% monthly drop in daily output will be sustained over 2 more months. If it did, gross domestic product would fall at roughly 75% annual rate in the second quarter. Mr. Zandi believes many counties will reopen before the summer and projects a 30% annualized decline in second quarter GDP. 30% annualized. So we'll look at what affected GDP in terms of 2008, 2001 within this, and then we'll look to the charts to get a good understanding of how that actually looks and how it's represented on a chart, which is, to me, the best illustration that you can have kind of for data in this circumstance. So, annual output fell 26% between 1929 and 1933, which was the Great Depression. Commerce Department data shows. So quarterly output fell almost 4% between late 2007 and mid 2009, which was the last recession, right? When we had the housing crash and the financial markets and banks went under. And that seemed pretty bad, right? If you were alive for that event, if you read the headlines that were coming out during that time, it seemed like it was really in a downward spiral. And that affected output around 4%. And, what everyone kind of considers the worst depression possible, the Great Depression between 1929 and 1933, we as a society remember it being as a really, really detrimental time for the economy. And that was a 26% annual output decrease. And right now, analysts are thinking we can see 30% annualized decline in second quarter GDP is a possibility here, because this is an unprecedented situation that we're currently seeing. So with those numbers in mind, we'll actually look at the chart from the Fed website right here, the Fed economic data, and this is gross domestic product, or GDP, all the way dating back from 1947, Q1 of 1947. We've seen this chart here, and as we can see, this right here, this dip, which is very noticeable. Other than that, we're looking relatively extremely consistent here with growth, other than 2008, which this little dip was right here. Looking back at the chart, you could say that that was pretty significant, because the rest of the chart is so smooth. So even if we change the chart and look at this more smaller data, we can see that overall it does look very, very consistent. There's not huge swings up or down, and overall it's a pretty consistent growth upwards. So this was that 4% that we talked about within the previous post. We can see right here, quarterly output fell almost 4% between late 2007 and mid 2009. So that dip right there is around 4% downwards in GDP growth. Now, what I also did is I looked at the GDP chart for TradingView, and then this is 2008. As we can see, from the high to the low, it's around a little over 4%, maybe at 4%, if it depending on if you're using candlesticks and if you're using a line chart. Obviously, this is a line chart because it's not really a price action, but yeah, if you're just using a line chart, it's around 4%. And if the article states that it is around, over 20%, 25%, the article states that it is a 30% annualized decline. So we see 25%. Look at the monumental difference in terms of how impactful this is to the economy of the United States. This was 2008. This was when people were jumping off of buildings who were bankers, and it was really bad at that time. Look at The Big Short. It was an implosion, really, and they got out of it through artificially low interest rates and a bunch of QE, aka just buying up assets. And yeah, they got out of it and they got rewarded for bad behavior. In my opinion, where QE, in my opinion, is not sustainable. It really is not. You haven't really seen inflation due to the velocity of money just going down since 2000s and just making substantially lower lows and lower highs. And it's going to go down even further, obviously, because of this whole pandemic. So you won't really start to see the inflation, in my opinion, right away, because of the counteracting of the velocity of the currency, as well as the rush to the dollar, because whenever you sell commodities, equities, the global reserve currency is the US dollar. If you're selling gold, you're going to sell it to US dollars, and then you'll sell US dollars to whatever currency you're using in another country. But a lot of people are looking for the US dollar for a safe haven. Look at Canada, look at Australia. Those currencies are they were absolutely tumbling. And, from that perspective, the US dollar does look like a safe haven, because you're thinking, wow, that's going up compared to every other asset, even gold and silver. But in my opinion, you got to look at the long picture. It's not about the weeks or months. It's a lot more than just that small time frame that you're looking at. But getting back to the GDP here, this is that same chart from, I guess it's a different tab. So this is the same chart, as we can clearly see. But this is that pullback that we are potentially going to be expecting. Like, the chart speaks for itself, right? Like, this is 2008. This is 4%, right? And then from where we are currently, it is a quarterly report, so it comes out every quarter. So we're not going to get it for a little while until late in summer here. But this is 30%, right around here, where the 30% is, and then the 25, just for reference, is a little bit here. But if we just take this out, and if analysts are predicting a 30% decline in GDP, this is what it could look like. And this dates back to 1947, right? That's a very long time to have a steady incline this consistent with, 2000 was right here. So this is the dot-com boom right there. You had a crash in early 80s, right? And you have these humps, or I think it might be in 82. This little hump here. Seems like you had one in 91. But at the end of the day, you're seeing such consistent growth. What are these little pullbacks here? 1.64%. We got one here at 3%. This pullback is 3.8%. We don't really see any slowdown at all, just straight up. This was another pullback here in 2008, which seemed significant, around 4%. And now analysts are saying that we could get a 30%. So just look at the decades. It is crazy to me to think that people are still bullish. That's just my personal opinion. I am setting myself up in a way that is very well positioned for the next leg down if we do get a next leg down. Sorry. So basically, I'll go over it with the TikTok. I was showing the Bitcoin chart because TikTok has copyright infringement issues when I present websites other than charts. So this is the GDP, and we can see it's been a very, very steady growth for a very long time. This is just for the TikTok individuals, and we've seen pullbacks of 2%, 4%, and this is a significant pullback of 2008. This little blip right here was 2008, pulling back 4% of the gross domestic product from the United States there. And analysts are saying that we could see potentially a 30% decline in GDP, which would be a massive pullback compared to what we've seen since 1947. This chart dates back to 1947, and in the 1929 Great Depression, until I don't exactly know when the final date was, but in the Great Depression, I know everyone understands what time frame that is. That was around 26% pullback in GDP. So this is not something that's unheard of. It's just this chart only dates back to 1947. So, if you do have more historic data, it would show a pullback that we could potentially look at for reference, but we don't really have a chart for that. I might be able to find it later, but with the current data that we have on TradingView, we don't have that. So yeah, I don't think that stocks are going to be going up. We're going to position ourselves to be very short, very heavy soon when we do have that retracement to 50% to 61.8 on the fib level. We'll talk about it when we get into the S&P, but yeah, let's get into a different chart. But that was kind of the discussion I wanted to have today. Okay, I'll get into the questions on TikTok later. We do have a decent amount of people coming in, which is great to see. And yeah, throw all your questions in the comment section below. I'll get through them. And then, yeah, let's continue on with this global macro update. The first three assets we're going to do are all commodities. We're going to be doing two precious metals, gold and silver, and then we're going to end off with some WTI crude oil. First things first is going to be gold. Let's go to the 4-hour chart and initially talk about it here. Let's get our snip. Snip right here. So we're creating these nice higher lows, which is awesome. So we got an anchor point right here. We have our first touch point, second touch point, fourth touch point, fifth touch point. So we got 5 touch points, 5 rejections, 5 areas where we saw demand come in, swoop up the price, and push the price higher than the previous resistance, creating a market structure, which is a series of higher highs and higher lows, which is bullish, right? Which is great to see. And we broke above a key level of resistance at around 1630, around there, and then we've come back, we've tested this zone multiple times for a new level of support. So in terms of the market structure, it does look sound for a potential long, but the resistance is not too far away. The area where you're wanting to take profit is not too far away, so your risk reward parameters are going to be lower in my opinion. And if you if we are looking for a move back up from the equities, from the S&P 500, necessarily we would kind of want gold to go down because they're negatively correlated. Not too much, but within the recent months, they're around negative 0.27, 0.25, around there of negative correlation. Pearson's coefficient of correlation, Google it if you don't know it. It's around negative 0.27 correlated in terms of gold and the S&P 500. So if we're wanting that pullback from the S&P, we would want to see gold potentially see a drop of some sort, and it doesn't have to be crazy, right? But we're seeing this nice ascending zone hold the price, creating higher lows, and in my opinion, we could see a little pullback here breaking this zone. If it does break above 1700, my bias will change. They're not too correlated or negatively correlated, sorry. So I will change my bias if we break the $1,700 zone. In my opinion, that would be a significant break in a key level of supply. And then I'd be looking for a nice higher low for then me to enter on that completion of the exhaustion before the next impulse move to the around $1,800 zone, which is our next area of supply if we break 1700. So that's definitely a risk reward that I'd be looking for. Super favorable would be a after break completion and then a pullback. We'd be looking for around $1,700, and then your next area of supply is around $1,800. Very, very great risk reward here. Is we obviously need to see the price action do a lot before we even think about entering in that situation. But we'll go into the 1 hour and discuss the more smaller time frames and what we could be seeing here in the short term. So let's jump in here. This is the 1 hour time frame, meaning that each candle represents 1 hour of time. And we see a series of higher lows that got respected, and it's in a very, very tight consolidation. So we're going to be more patient in entrance, because right now we're just going sideways. And yeah, you could argue that the price broke the descending zone, as we can see right here, and it's now testing as a new level of support in confluence with our horizontal zone as well as our ascending zone. So there's a lot of support where we're currently holding around 1640s, which is a key level of support for gold right now, because we have three zones that are all coming together and forming a strong level where there's going to be potential buy volume right around there. So it's looking pretty good, but one thing to consider is you haven't really broken the market structure of the consolidation. So in my view, we're still consolidating in this tight range right here, where we have a resistance around 1660, 1650, somewhere around there, and we have a nice level of support, and we're just going sideways right now. Yes, we did break the descending zone, so the bias is a little bit more bullish, and having an entrance at close to an area of support would be probably a pretty high probability situation, because not only are you getting a great risk parameter when you're entering at that area, but you also get a great reward, giving you a solid risk reward trade opportunity that is obviously favorable compared to a risk reward of like 2 or 1.5 or really 1. I really only like to trade structures that allow me at least a risk reward of 2 to 1 minimum, bare bones minimum. Before that, I'm not super interested. But as of right now, we're in a consolidation. For me to really want to look for a potential entry for the highest confirmation trade, not within the consolidation, would be a break in the structure, breaking the resistance, and then testing that resistance as a new level of support and holding. You're seeing buy pressure come into the market. You're seeing injections of buy pressure pushing the price, holding it above the previous level of resistance, going to be a new level of support. Market structure, very simple trade. Overall structure is up. In my opinion, pretty high probability situation to get to 1700. It's just a matter of if we're going to break 1700 or if we're going to reject off, because this is a strong level of resistance or supply. So that is just the question. We'll see how it goes. I'm going to play it pretty safe because, in my opinion, these tight consolidations, you get these big breakouts here, and in my opinion, I'd like to see more of a confirmation. I don't really want to be entering within this zone. This is a no entry zone for me. I'd rather wait until a confirmation of a break with a market structure lower low, and then you'd be looking at a lower high entry for a short. But then if you're looking for a short, we've already said silver looks more of a short. Why is that? The weekly and monthly chart is a huge difference. On silver, you're seeing lower highs, bearish. Sellers are pushing the price down. On gold, you're seeing higher lows. Bulls have the market control, right? They're able to push the price higher and higher. Look at the weekly chart for the two different precious metals. They create different market structures, and this, for me, gives me a different bias and allows me to have options in the market. If there is a sudden shift in trend, I have the opportunity to both look at longs and shorts, depending on how the market is behaving, which is, in my opinion, a great opportunity instead of just being long biased for gold and silver and just thinking long because there's a recession. You're like, holy, it has to go up because it's a safe haven. People have been telling me that it's going to go up because of a recession, and in my opinion, there's a little bit more to it. There's a wealth transfer occurring kind of at a mass scale, and right now a lot of the wealth is going into the US dollar. It really is a tremendous amount, and until there is that fear of inflation, you can look at that. CPI is a good one. Consumer Price Index is a really good one. Just understanding, they're not stopping at $2 trillion. They're going to do another one. I saw at $1 trillion, which is, a drop in the bucket in my opinion to what they're going to do when the next wave of sell pressure hits the stock market, because this bounce is going, in my opinion, to fail. Obviously, everyone has their own opinions. I do not think that you should follow anyone just because you think that, they're right and you don't know. Always do your own due diligence for yourself. Look into it. If you're not sure, don't invest or trade until you have a firm understanding of what instrument you're trading and what affects that instrument. And yeah, you're not going to get everything. You're really not. But, trying your best to first back test it, find a strategy that works, and then at the end of the day, just, being able to manage risk and be patient is a huge thing in trading. But yeah, not going to get into it. Let's continue on with silver. We've already talked about really all we need about gold. Gold, like I said before, looking for more of a long. We're looking for that market structure to break. On silver, we're looking for mainly shorts. And let's take a quick look at the weekly, right? We see on the large time frame, huge boom, lower high, lower high, lower high, right? So let's go back to the 4 hour and let's just quickly look at gold. At the weekly or even monthly chart, we can see very, very different chart, right? Hugely different. It's not night and day, but the macro outlook is very different. So I'm going to trade it that way until silver shows me that it is able to really push up and create a new market structure, a new trend. Because right now, in my opinion, we're still bearish because of that massive drop that silver had. And we can see, it kind of mimicked BTC's drop where it just kept on going. And then at one point, it was just absolute capitulation. BTC dropped 50% in a day. Silver dropped, we can see right here, 20% in 4 hours almost. That's just unbelievable, but yeah, it happened. And now we're getting our pullback here, and like I said before, we're looking a little bit more short on silver because of the macro pattern of the lower highs. So we are seeing a retracement back up here, but the end of what we're looking for at the end of the day is going to be the price action to break, which is an ascending zone, creating, you could look at it as a potential wedge, you could look at it as an ascending triangle, but I'm just viewing it as an ascending trend line that is holding the higher lows. What I'm also looking for is a horizontal zone that is a significant area where price has been respecting as a resistance and support in the previous price action. Very clear spot at 1480, 1470, very easily identifiable on the 4 hour and 1 hour chart. So the setup is basically here. Right now, we are still holding the previous resistance as a new level of support. So it does not make sense to enter short at all. The market structure is still looking more like a long opportunity in my personal view, because you're seeing a nice squeeze right here. And really, you're just waiting for the price to make a decision. But we've already discussed why the bias for gold and silver are different, and when we do see the buyers start to increasingly enter into the precious metals because of the worry of inflation, we'll obviously change our bias for silver, because silver is going to be the more volatile, more speculative precious metal out of gold and silver. Gold is regarded more as a safe haven, while silver is a little bit more speculative, but still a great opportunity. But there's a time and place for it. So yeah, that's basically it for silver. We're looking for a key break in this zone. I think we can even, let's just refine it a little bit more, because it, in my opinion, was a little bit large. So if we go like this, and then copy this horizontal zone, and then just put it right there. Now we see that it's a little bit more clear of a pattern, and very, very simple to understand what we're going to be looking for a potential short. We could see a reverse, normal head and shoulders. Let's just talk about potential price action patterns here. So one option would just be a simple break in the resistance, turn support, as well as support in the confluence. You see a lower low. You're looking for rejections at the horizontal level of resistance, not just once, but you're seeing at least 2 injections of sell pressure. That would be ideal. And then you're looking for shorts. And if it gets into a third, and if it holds with a bearish engulfing candle, man, oh man, that's a great opportunity in my opinion. So if it breaks down, you get 1, 2, and then you get a trickle, and then you get one more pop, and then it holds, and then you get like a bearish engulfing candle with a wick maybe, like so. Man, oh man, in my opinion, that is going to be looking like a great short. But as of now, that's going to be option number 1. Option number 2 is if we slam back down here and we don't get a little lower low, and then a pullback, and then a nice consolidation kind of like within this range, like we can see right here. That's a consolidation. That's a nice little consolidation where you get an ascending zone and then it breaks to the downside. That's a great setup if we do get that right there. So if we get like a break and then it pull back, and then you just draw an ascending zone. It could be a wedge, could be a horizontal level, making it an ascending triangle. But at the end of the day, you're looking for a break in that ascending trend line. You're looking for failure, retest of the previous zone, mini version of the larger zone, and then you're looking for that move to the downside. So that's definitely an option here. But let's say it hits $14, but it bounces back. Well, this, in my opinion, is still a potential reversal pattern, right? This is going to be a head and shoulders where you see the left shoulder, you see the head right here, and then you see the right shoulder as a potential opportunity. If it does get to $14, and if it actually comes back up to almost $15, around, let's say, $14.80, if it gets back up to $14.80, which is the right shoulder, $14.80. That's a terrible 8. Let's just redo that, because that was really embarrassing how bad that was. That's a little better. All right, so that's around 1480 is the right shoulder. So that's an option number 1. If we don't get the small little pullback around the resistance there. So we got a couple options. And we want to ensure that initially for our entry, I think I'd like to see a stop loss above maybe this wick. I think this wick's too high. That was a little bit of an exaggeration move to the upside. It got rejected pretty quickly there by the sellers, so we know that there's sell pressure within the market. But I think this wick is good. If you want to be a little bit more aggressive, you could go up to, you could split it, or you could just go up to the candle closure. But I think if it does break this zone, it's a pretty high probability situation. So you want to give it a little bit of room, but that's going to be basically the outlook that we're going to have for silver. So I went over, let's say, 3 different options that we could see for a short. If we don't see something that we have an edge trading, we just don't enter. Very simple. If you're entering the market with no edge, that's gambling. That is gambling. You don't have any edge or any data that shows that you're able to make a consistent amount of money over a series of trades, not just one trade. I have no edge in one single trade. I don't have insider information. I don't. So I have 0 edge if you're telling me you have to make money on this trade. I can't guarantee that. But I can't guarantee making money in a series of trades, but I have a very, very, very high probability of being able to make money on a consistent basis month over month because I have edge in what I know, and I just stick with that, little sliver within the pie of the market. And if that pie isn't there, if my sliver isn't there, I don't eat. I just don't enter because taking unnecessary trades out is just as important as putting necessary trades in. A little bit of psychology, a little bit of nugget of information there. Let's now go into U.S. oil. Let's go into the 4 hour here. In my personal opinion, I think we could get another little top here. Let's talk about market structure. Also, just to let you know, we will be going over the S&P a little bit later, just for your information, because I know someone asked within the TikTok. We will be going over the S&P very shortly. So WTI crude oil, on the 4 hour chart, we see this descending zone that connected the lower highs. Really, really perfect squeeze here where we got the descending zone connecting the lower highs. We got 1, 2, 3, 4 areas right at $20. Not only is it a key zone on the chart, but it's a psychological zone, very round number. And then we got a squeeze, and it was really right at the apex. Now, usually, if it's right at the apex, it's probably going to have a pretty aggressive move because it's that so close to it, and that's exactly what we got, right? We got to push the upside, pull back, push the upside, another pullback. So then this actually broke the minor market structure. This is the most significant high in my eyes that I can see, and it broke it and it retested. That was a really poorly drawn horizontal zone. Let's try that again. We got a nice zone right there. Previous support, new resistance, creating a tiny consolidation. This is going to be either the volume accumulation phase or the volume distribution phase, depending on how you're viewing the market. Because it broke the descending zone and it held that base so well, and it's very extended to the downside, you can kind of assume that it's going to be some level of a pullback because it can't move down forever. Looking at the weekly and the daily, it's just an absolute demolished market cap of crude oil here. So, the market moves in waves, and that's exactly what happened. And in my opinion, what we're going to be looking for now, after the strong push to the upside, we validated this high as our main level of resistance at $28. It was also our structural level of support when we broke down and gapped to the downside before we pushed to the downside again, continuing the momentum. So it's a strong level of this $28 zone, and we're currently seeing it reject once. And in my opinion, we see a nice, let's get our, what's happening here? I got to get my custom pen white. There we go. Okay, I couldn't draw for one moment there. So then we get a series of lower highs and a horizontal zone at around $23. So this is a key level descending triangle, and I don't think it's going to go all the way down. We're probably going to get another test of this high $28 zone. Once we get 2 tests and 2 rejections, we can probably call it some level of a consolidation going sideways, but at the end of the day, the momentum is very, very bearish. Definitely very, very bearish in my eyes. So if we do get a consolidation, having entries around $28 is probably not a bad area to be looking to enter, because if it does go above it, you're going to be looking for a stop loss to take you out, and it's probably going to move up all the way to 35, would not be surprising, or even actually close the gap to 40. But in my eyes, I'm going to be viewing the market as a consolidation when it does break this descending zone, and then it's probably going to be testing this $28 range right around here. And then once we get a test, maybe a little mini double top in the larger double top grand scheme of things, would be a good opportunity here. So that's going to be what I'm going to be looking out for. I'm not a huge crude oil trader. I don't really trade. I haven't actually traded crude oil here. I've just been analyzing the charts because A, I love price action, and B, it's been very interesting. But gold and silver are more my trading enjoyment, and then also the S&P. But I'm definitely looking into potentially trading. I use contracts for differences. It's basically you're not trading the actual asset, you're trading a contract that is a contract for the underlying asset, and it's very flexible. It's very easy to margin trade, and it's a very dynamic instrument because it's a contract. It's not like it's not like you're like buying bullion and like selling it. That's a very difficult thing to have flexibility in your trading. Like, obviously you can't set a stop loss on it because you have to go sell it to someone who's wanting to buy it at like physically, right? That's like the least flexible type of investment. I have bullion in front of my computer here, but yeah, that's more definitely of an investment, and contracts for differences are primarily for shorter term trading here. I swing trade, but day trading, swing trading, all that stuff. So that's my analysis on crude oil. If I don't really see anything I'm interested in, if I just see it continue down here and break the $24 level of support, I'm not really looking to enter. I kind of have an idea set in place that I'm wanting to see, and if I don't see it, I just don't enter. Very simple as that. I'm not going to chase anything. I'm very, very. You got to be careful in what you enter, because every entrance matters significantly. Really, really, really good quote. You're only as good as your last trade. That's a really, really good quote that I like to really remember. You're only good as your last trade. So it doesn't matter what you did last week, last month, last year, yesterday. You're only as good as the next trade that you're going to make. So you better make it count kind of mentality. It is the approach that I like to take. Obviously, yeah, I take some trades that I wish I didn't take, but at the end of the day, the goal is to take every single trade you want and leave everything else and be super satisfied with the trades you take. Doesn't matter if it's profiting or losing at the time when you're entering or in the trade, because at the end of the day, you have confidence in the system to make you money over a series of trades. All right, now let's get right into the S&P. Now, the overall daily chart we're looking at here is going to be the retracement back to the 50% or 61.8 fib level. That's going to be the targeted range here for this pullback. We're actually getting pretty close to it, and you know, actually looking at it, I didn't really see it before, and I'm not really going to be looking for longs at this point for the S&P. But this, in my opinion, actually is a head and shoulders pattern, and you might not be able to see it right away, but or you might have seen it before me. I didn't really call this until I saw the pullback and then the validation, and I was like, looking at the daily, it's just this section from March 12th to March 19th is so messy. That was a super messy time, which then distorted a lot of kind of the flow of the market, you could say. But we can see that. Let's just get the head and shoulders. I don't know why I grabbed fibs. We can see right here, this is the, I guess you can, it's a little bit messy. This is kind of the left shoulder, and you get a pullback right here. This is the head, and this is the right shoulder. I know that this is very messy, the left shoulder, but this is kind of what I see. Now you're getting a pullback, validating the 2640 zone as a new level of support. And that's the reversal pattern that came into the SPX here. And let's jump into the 4 hour to discuss more of a smaller time frame that we're currently going to see. So as of right now, we are making a series of higher highs and higher lows. We broke a significant resistance at around just above 2600, 2630, around there. And we broke, structurally made a higher high on a large time frame like the 4 hour, which is great to see. I'm just going to put my batteries in here on my mouse. It's not letting me... Are you seeing this? Okay, that's super weird. Let's just close this and try that again. That was a little odd. I don't think that was my mouse's fault. I think that was Snip here. There we go. Okay, so we saw a higher high form on the 4 hour, so that was a significant higher high that held, and now we are holding that previous resistance for a new level of support. Pretty bullish, in my opinion, on a pullback. Now, my view is that we're going to have two more massive sell-offs, even more aggressive than the one we saw from 3,400 down to 22. I know it sounds crazy, but look at the couple of previous global macro updates. We've been talking about it for a while. We talked about GDP, gross domestic product. Like, look at the actual numbers that are coming out. How in the world is that bullish? You know, for one, I don't even know how this is even going up. But for one, like, there's 10 million people who filed for unemployment. No one's going to be buying stocks when they're filing for unemployment. Number two, buybacks are now out of the question. A lot of the stock market was buybacks, right? Companies buying back shares. Now, what companies buying back shares? No companies buying back shares. So, personally, this is either shorts covering or just the first wave of sellers, and then everyone's just holding, and then, you know, the 2 trillion stimulus is getting into the market, so we're getting our pullback. But, you know, that's basically all that's propping it up here, is just the Fed printing money. And how sustainable is that? Their mission, as you know, Keynesian economic theory suggests, you know, there should not be any recession. It's preventable. That is their theory, is it's preventable. You know, that just doesn't make sense. In my opinion, if you have credit, there are cycles. Credit and debt, there are cycles. You know, you are borrowing the prosperity of the future to benefit today. At some point in the future, you have to pay off that debt in order to take out that debt and settle the transaction. You can't just have more and more and more debt come in forever, for infinity. That's when debasement occurs and fiat currency becomes a thing of history, and it's happened before. Look at Germany. Look at even Rome back in the day. You know, they were initially 100% silver or gold, and then they slowly put shit not as precious metals in there and slowly debased the currency. It's happened time and time again after, you know, economic huge power comes in, and then, you know, they get too greedy. They use this monetary policy of money printing, you know, to prop up whatever they're trying to do, war, markets, whatever it is, and then at a certain point, it can't take it, and it pops, right? And then banks go under, and that's another bullshit thing that I don't believe in, is complete bailouts for everyone. That's not a free market society. That's like, at a certain point, the government's going to have to bail out everyone, and they're going to, at some point, in my opinion, take equity, and then it's going to become communism, right? Government's controlling almost all business. They're going to set prices on certain things. That's the opposite of what free market thinkers are looking for. And, you know, in my opinion, that's the best way to run an economy. Very, very small, little government that does its part. Yes, I do think that government should play a part and a role in society, but I don't think that they should do as much as they're doing, basically. I really don't think that they should, but that's just my personal opinion. All right, so that's going to be the S&P. Key level of supply at around 2950 to 2800. So basically, what am I going to be looking for? A pullback. I'm not going to be looking too long. This is a pullback, and we're going to be looking for the market structure to show weakness around 2900 to 2800, 2940. But what we're going to be looking for is weakness around this zone, and we have a nice ascending zone where we have two series of lows, one being a higher low that held, and we drew a trend line there. It would be nice to get one or two more validations of this zone before we use it to take the trade. But, you know, even if we consolidate right here and then we test it one more time before pushing down below, that's all I really need. But first, I would like to see this zone hit, because we've backtested 2001 and 2008, and both times all two legs of the stock market crashes in 2001 and 2008 pulled back to the 50 to 61.8% fib level on the exhaustion move before the next impulse move to the downside. So that, like, I'm not thinking about news in terms of like what CNBC is saying about bullish bears, what analysts are saying. You know, I used the data that I got from 2001 and 2008 and said, okay, what happened? Psychology usually tends to rhyme. It doesn't, it's not exactly the same, but it rhymes. It's similar. So, you know, we created a structure and a system that allows us to understand what happened in the previous price action and then portray that same system to current day. And then hopefully it'll work, basically. That is going to be the speculation, basically. All right, so that's going to be the SPX. We're looking for failure of the ascending zone with market structure, but, you know, if you've been following us for a little while, you know exactly how we trade these ascending zones. Very, very common within a downtrend, and we're basically going to trade it the same as every other situation. Quick talk about the US dollar index. Well, we're seeing a consolidation below 103, 102, 103-ish. We're looking at the weekly chart, so we're not like trading this, day trading or anything. But we're just understanding the strength of the US dollar. Now, the US dollar currency index, DXY, is comprised of, I believe, 60% the euro, 15% yen, and the rest in smaller currencies. But that's what the US dollar currency is comprised of, and it kind of represents the strength of the US dollar against other fiat currencies. And right now, after the massive shoot up, we are seeing a consolidation, but I think if we do get that next leg down of the SPX, we will see another surge in the US dollar, because in order to sell an equity, you need to buy the US dollar, right? It's a pair. Every share is a pair. You're just not associating the US dollar because in Forex or crypto, you say BTC USD, BTC USDT, or Euro USD, or whatever pair you're trading. You say the pair, but in stocks, you just say, whatever Apple or Google or whatever you're saying for stock or shares or whatever it is. But there is going to be buy pressure if people are selling equities. So this is probably going to go up, which means it's probably going to be a little bit more bearish for gold. And that's going to be my viewpoint here until we start to see the shift in trend. But that's going to be the global macro update complete. I am going to put my phone on my charger because my plug-in unfortunately is not charging. So it's going to just close this. You're not going to be able to see much on the TikTok, but I'll answer every single question basically. So I got to put my thing on the charger here. I don't want to cancel, and I'm going to put my thing right here. And now you won't be able to see much, but I'm basically just going to be answering questions from all the TikTok questions as well as the YouTube. So I will close this global macro update. Thank you very much for watching. If you found this useful, educational, informative, entertaining, definitely subscribe if you enjoyed it, and we would greatly appreciate it. If you would like to know more and would like to get a weekday, we do these videos every weekday, but if you'd like a weekday basically analysis of what we went over, going over different fundamental topics, some news articles, some important, informative, educational stuff, as well as diving deep into the charts, definitely join our Discord. We can find high quality analysis. You can find the Discord on our website or our Instagram. Just go to our other social media platforms and you'll be sure to find it. You can't miss how to find our Discord if you manage to find our website. And our website's performante.ca. But go to high quality analysis and you get a video every weekday of a crypto market update as well as a global macro update. This was yesterday that we made. Stocks continue to rally. Is the bottom in? We think no. And this video actually goes in depth as well, going over kind of what we're looking for. We were waiting for that 50% to 61.8 retracement. So we're consistent with our message. We're not deviating, saying bullish, bearish, bullish, bearish. We are very consistent with trading, really, in terms of our bias. So definitely stay tuned if you're interested in financial markets, in traditional markets, as well as cryptocurrency, if you do find that interesting. So that's going to be the completion of the global macro update. Thank you very much for watching. Like I said, we'll complete the global macro update and then turn the video off, or the recording, and then we'll answer all the questions. So thank you very much for watching, and until next time, happy trading. All right, so that is the completion of the global macro update. I'm just making sure it's saved, and it did. Okay, awesome. So that is done there. There's only a few questions on YouTube, so I'll go there. Lol, nah, just different account I'm using. Okay, so are you just looking to do more trading? Are you looking to do more trading other than just crypto? Yeah, so we do our global macro updates for SPX, gold, and silver. So yes, are you looking to do more trading just in crypto? Yes, definitely on that one. So now going on to the questions on TikTok. Let's just go all the way back here. If you have any questions, definitely now is the time to write them. I'll just go over every single question that you're going to ask. Unless you're like asking, like, is Apple a good buy? Like, I'm not a financial advisor. I'm not going to tell you, but let's go here. Matt said, I think recovery is going to be quicker than the depression or 2008 financial crisis. Well, just first thing, the 2008 financial crisis was not nearly as bad as the Great Depression. So those are two very different things. But if you think that it's going to be quicker than the 2008 financial crisis, we have a difference of opinion, but I respect that you have your thesis and your own thoughts and opinions, and I wish you the very best in the financial markets. So you can kind of explain why. I'd like to know the other side of the fence, because I don't think that, but it's great to discuss with individuals with different opinions, because then you get a better sense of what, not just like, because it's easy to get stuck into your own brain, but if you talk with different individuals who have different forms of opinions, you can kind of battle your reasons and kind of test your theories as to why you think it's going to be bearish or bullish, basically. It's good to discuss, in my opinion. And crypto. All right, let's go in here. What are your thoughts on the SPY? Hopefully I answered your question, Bobby. If you go to our YouTube and go to previous global macro updates, we have a playlist that we post our global macro updates every single weekday. You will be, and we also timestamp it. So if you go to the comments, you'll see SPX 500 or something along the lines of that, where it's going to represent the SPX or the SPY. Same thing, same index. That's going to be the thing that you're going to want to be looking for if you're just interested on the SPY, because we do a daily on the weekdays video showing, we go over every single day basically, so definitely keep a lookout. And we go over the 4 hour and hour time frame, so it's not like on the minute chart we don't really have any actionable items that you can address. It's more longer term macro shift that we are trying to anticipate. So in my opinion, it's harder, but at the end of the day, we're going to rely on data, not the news. All right. Data meaning price action, right? Price action volume, the tape, that is going to be my source of information, because it's unbiased. It doesn't have feelings, doesn't have biases. It just shows me the information. That's the most trustworthy thing I am able to find. Politicians, governors, individuals who have different opinions on bullish, bearish, different analysts. I could not care less on what they say, what their opinions are, because the price action, in my opinion, is the end-all, be-all location to find information on opportunities. Not solely, but like as the last validation. Like, is this something that I want to look for an opportunity? Is this looking like a good opportunity? Price action is going to be the thing that I turn to. Gush. I think, what is Gush again? Wasn't it a gold something? Oil, that's what it was. Directional S&P oil. Yeah, so I don't really have much to say about this. Provides 3x daily exposure to equal weighted index on the largest oil and gas exploration and production companies. So definitely check out the oil analysis if you would like to know my opinion. I trade contracts for differences, or CFDs. I don't trade equities, so take that with whatever you kind of like want. Different asset classes kind of all together in a sense. Obviously it's the same market in a sense of the oil market, but I don't like gaps just because I can't manage risk on gaps. I'm a swing trader, short-term swing trader, and I can't manage risk on gaps. You can't sell if a stock goes from $20 to $18 and a gap down. You have zero, you're illiquid for that period of time. You gotta hold. And yes, on weekends, contract for difference markets do not operate, and that's why crypto, in my opinion, is the best fucking asset. It's terrific. It doesn't close. I'm liquid 24/7, 365. How perfect is that? And yes, there comes with some downfalls because of the difficulty with managing positions literally 365 days of the year if you are trading, but I've just described to you my main reason that I love 365 markets, 24/7, 365 markets, is because of the fact that I'm liquid at any time. I can convert it into Tether, Coinbase's stablecoin, Binance's stablecoin. Pick it what you will. Some are more liquid than others. Tether's the most liquid out of any single stablecoin, so I choose Tether specifically for that reason, due to liquidity and lower spread, lower cost. Obviously, it's beneficial if you have more liquidity, but at the end of the day, you can trade into a stablecoin literally 24 hours a day, 365 days a year, and there's not any other asset class that you're able to do that for such a low fee. There really isn't. So that is why crypto, in my opinion, is a great asset class to trade. Not only is it low fees, 24-hour markets, great trading platforms like Binance, and very simple to enter. If you're in the States, you have the pattern day trading rule. You need 25K to trade more than 3 trades a week, I believe. I don't exactly know if it was 3 or 4, but like entrances and exits. But I'm not American, but they have regulations that prohibit people who want to day trade from trading more than they want to if they have less than $25,000 in their account. Crypto, you could trade $10, you could trade $5. Actually, $10 is the minimum Binance, but you could trade anything over $10. But if you're putting $20 in, I think anyone can manage risk with $20. But yeah, that's a couple of the reasons why I prefer crypto over other asset classes as kind of my focus and where I'm developing my skills as a trader. In my opinion, it makes sense to focus on one asset class and then diversify, taking only the best setups. But I view crypto as my primary focus and my number one motivation to get as good as possible trading is in crypto. Commodities, gold and silver is great, but I just think that blockchain is super interesting and it's going to play a vital role in the new monetary system that is going to be taking place if this one crumbles. You never know. Fiat currencies do not last forever. They actually don't last very long. Few hundred years really. Which, seems like not a long time, but when was the US dollar created, right? Think about it. Research. All right. Wow, really? Bobby, I don't really know what that is. Just joined. What stock is this? It's probably the S&P 500. Bobby, thank you for the share to Dennis J. Welcome, everyone. Yeah, so if you have any questions, definitely drop them in the comments below. Also on the YouTube if you are looking for that as well. So let's go ahead. I missed it a long time ago. What is the red zone? So you're probably talking about the S&P 500 or this SPX. The red zone is going to be my main supply zone that I'm looking for the price to show weakness. I found this zone using a Fibonacci retracement from the 50% retracement up to the 61.8 retracement from the very high to the very low of the market structure of that huge push down. That is where I found the pullback zone. Backtest it. There is going to be look at previous YouTube videos that I did on Global Macro Updates. They're going to give you a system that's back tested in 2001 and 2008 that has a high success rate basically, and that's the system I'll be using to try to capture profits in this potential next leg down. I'm going to say potential, but yeah, I have in my opinion, a high probability situation on my hands that I'm going to be betting pretty fucking heavy on, because there's no way in hell that the stock market is going to rebound like it did in 2018. Like, people bought the dip on that and got rewarded so hard that like right before Christmas, it was just a 4 or 5 days straight of just massive bear market days. And then after Christmas, we got a huge bull market, and 2019 was a phenomenal year for stocks. And people who bought the dip in 2018, like Q4 of 2018, got great returns. And that, in my opinion, is another dip buy right now. Perma bulls who think that it can never go down, the Keynesian economists are thinking, holy shit, buy the dip. It's a sale of 30%. Well, in my opinion, it's going to go down to 50 or more. And to me, that's reasonable considering what the current economic situation is, with GDP potentially going down, plus 20% with unemployment claims reaching 10 million people. Like, that's crazy. Look at the chart. That just, in my opinion, blows my mind that people are buying the dip, and it's a difference of opinion. If you're bullish, keep your opinion. I firmly agree that every person should have independent thought. So if you have that bias that you're buying the dip and it's going to go up, I respect you coming up with your own reasoning and your own thought process, your due diligence, your homework into analyzing all information you can and coming up with your own conclusion that you're either going to think bullish or bearish. Because there's three things you can do. Hold on the sidelines, which is still a position you're holding in cash, or you're in the asset, or you're selling the asset, really. So, all right, what is the dollar index called? The US dollar index, the ticker symbol is DXY, and it's a US dollar currency index. It is comprised of, I believe, 60% euro. So it's a pair, right? So it's 60% euro, 15% yen, and I don't remember the rest of it. It's in smaller increments from there. But yeah, it's heavily reliant on the euro for the pair. So the chart is going to resemble somewhat similar to the currency pair with USD and euro. Grab that. Thanks for all of that. Yeah, no problem. Happy to do it. Not sure if my question remained, what was the dollar index called? Yeah, so hopefully I answered your question. It is going to be DXY. All right, let's go all the way back up here. I missed a few questions. Okay, so I got that question. I got in on Gush at 1262 and APA at 466. Still holding. Thoughts on next couple weeks. I'm personally not going to do a full technical analysis on your current trades. We have consultation if you'd like, but in this current situation, we're not going to show all that. Sorry if that is not going to happen, but with the information that we got for global macro, hopefully I give you some level of insight or what we think in terms of what could potentially go down. Which platform can you use to trade crypto? Depends on what country you're living in. I am living in Canada, so I use Binance. Basically, if you're living outside of the States, Binance is your best bet. In my opinion, it has the best UI. It does have the highest liquidity. In my opinion, that is very, very important in an exchange. Yeah, I don't have a whole lot more to say. They're an absolute beast. Their coin BNB is an absolute beast as well. An exchange token that is going to see some unbelievable price appreciation in my personal view, which is not investment advice at all whatsoever. Always do your due diligence, but just a quick little tidbit. Look at BNB, Binance Coin. In my opinion, absolute beast of a token. All right. Coinbase is what I've heard about. Yeah, Coinbase is more for investing. It has high fees. If you are living in the United States, I can never condone using a VPN, but there are people who do use a VPN. And if you do use a VPN, you have options in the derivatives market, meaning that you're not trading the actual asset. You're trading perpetual contracts, meaning that they're more flexible. You can, set take profits and stop losses while you enter the trade, unlike Binance, where you're actually purchasing, Link, XRP, BTC, you're actually purchasing the coin, and you could put it onto your ledger, whereas on these derivative exchanges, if you leverage up 5 times, you can't take that 5-time leveraged amount of Bitcoin and put it into your ledger. Whereas on margin for Binance, you can. You can actually borrow coins and send it to your ledger if you really wanted to. All right. Will Bitcoin go up in value after May 2020 halving, or would it go down first? Mark. So, good question. In my personal view, I think that the mining capitulation cycle, round 2, will be in confluence with the next major market breakdown. So in my opinion, BTC will have another significant bearish move to the downside. There are a couple of reasons for this. One, the Bitcoin market, not as much altcoins, but specifically Bitcoin, is positively correlated with stocks, with the S&P 500 in particular. It is I believe 0.75 0.75 in correlation, positively 0.75 in correlation with the S&P Bitcoin. And that 0.75, look for Pearson's coefficient of correlation. That's what it was. Pearson's coefficient of correlation. Google it. It's a scale. If it's like Bitcoin is 100% correlated with Bitcoin, right? You can't argue that. So the scale is going to be 1 because it's 100%, right? The S&P correlated with Bitcoin is 0.75. That's really high. So right now the S&P is pretty correlated with Bitcoin. So I'm going to project my bias on the S&P with Bitcoin in confluence with the mining capitulation cycle, with miners coming into the network, mining, which increases the hash rate, making it more difficult for miners to mine Bitcoin and get rewards, which then pushes hash rate even higher because, with more miners trying to mine, it's going to get more and more difficult until a certain point it pushes the price to actually mine so high up that the least efficient miners are going to get basically bankrupt, where their asset that they are mining, which is Bitcoin, costs less than the actual cost to mine it. So let's say it costs them hypothetically $10,000 to mine one Bitcoin that is at $6,000. Well, just thinking in terms of simple math, that doesn't make sense. You're in a business that's losing money with every BTC, with every sat you mine. Right? So it doesn't make sense. So they're going out of business, which means that amount of that BTC reward will get allocated to the most efficient miners because they're going to be able to withstand that pressure from the increasing hash rate and the decreasing price of Bitcoin. There's a squeeze there, and inefficient miners will not be able to withstand this squeeze. So they're going to have to pay for their electricity bill, pay for their employees, pay for the rent if they're renting a building, whatever it is, in fiat currency. They're not going to pay in Bitcoin. You're not going to pay your electrical bill in Bitcoin. So if what you're mining is decreasing in value substantially, it just doesn't make sense. They're going to go out of business, right? So then that reward is going to get allocated towards the highest efficient miners, which in my opinion is a free market system that Satoshi Nakamoto has brilliantly created, which somehow creates maximum efficiency in allocating that capital to the most maximally efficient businesses to build them even greater. So it's like the capital is getting fed because it's easy to mine at first, but then once that is given up, that reward is getting that money, that wealth is getting flowed into the most efficient miners, which in theory is what you're wanting. Because you gotta clean out, the inefficiency, or else you get the United States economy. Oh, jokes. Kidding, all aside. But, yeah, let's continue on. So, hopefully that gives you an understanding. I am not expecting Bitcoin to absolutely moon after the 2020 halving. I'm actually expecting it to go down in value, but I do expect a larger term chart and the larger term outlooks to still be bullish, but I'm not going to be looking to really have my perma bull hat on until we start seeing a weakness in confidence in the United States dollar. Because that's when we'll see inflation. When people start to worry, holy shit, they're printing trillions of dollars. They're giving money to everyone, right? And at a certain point, it could be a long time. We could not see the velocity of the US dollar bend towards the upside until this entire crisis is over. We don't know this, right? So there's going to be a certain point. We've already got the money supply. That's checked. That's very, very substantially overgrown. Now all we need for inflation is going to be the velocity of money, which has gone down substantially since basically the late 90s. It's been going down significantly for 2 decades, and that's why we haven't seen really the inflation of 2008 other than in, real estate markets and financial markets. But you haven't seen it in food, in services, and all that stuff, because the velocity of money is just keep on going down. So it's counteracting kind of the inflation that you would see from the increased money supply. All right. I believe there will be another serious decline. Would you be smart to buy? So yeah, like I said before, I'm not going to tell anyone what stocks to buy, what to look like. I'm going to tell you what I'm going to be looking for, and you do whatever you want with that information. I'm not a financial advisor. I'm not a financial planner. I'm not going to tell you what stocks to buy. Sorry about that. Let's move on to the next question. Do you have a timeline for the retest of the bottom? Retest of the bottom. I'm not sure what you're talking about. So I'm not looking at timelines. I'm looking at price action. If it consolidates and doesn't hit my zone for 4 days, 5 days, 10 days, it really doesn't matter, because I'm not going based off of just price. I'm not going based off of just time. I'm going based off of the price action, volume, and different instruments that I'm using to create more confluence for the decision that I'm making. So yeah, I can't give you a time frame. I can't say in 2 days and 4 hours you should really be shorting this because it's probably going to be hitting some level of supply. Like, yeah, sorry, that it's not as easy as that. I wish it was. So yeah, that's going to be the completion. If you have any other questions, that's great. I don't really see any other questions really. So that is going to be the completion of the global macro update. Thank you very much for watching. Yeah, no more questions. So yeah, we do this every day. So if you're interested in learning more or would like to have more questions, we will be doing this tomorrow as well. So stay up to date with all things economics and crypto if you would like. So thank you very much for watching, everyone. And until next time, have a good one.